In today's episode of Cuppable, we are going to break down a case study that I'll say is a very common situation that we run into. So we're going to talk about a hypothetical situation where there's a couple age 60. They have $2 million of retirement account money that they've saved up. That's all pre-tax. For the sake of this example, we're also going to say they've built up a substantial taxable investment account. We'll call it $1 million. And so what we're going to do in today's video is we're going to talk through, if they plan to retire in 5 years, what are 5 planning considerations for them to be thinking about before they retire? And then what are 4 planning considerations for them to be aware of and be thinking about for after they retire? That said, welcome to Cuppable. My name is Michael Dunham. I'm the Director of Planning here at Fontana Financial Planning. With me today is Chad Hayner, one of the partners of our firm. Welcome, Chad.
Thank you, Michael.
Cheers.
Pleasure to be here.
All right, so Chad, to get us started, I want to go ahead and kick it over to you for item number 1 on our list of things to consider and be thinking about before retirement, which is funding tax-advantaged accounts. So with that, why don't you go ahead and break down a couple of our favorite tax-advantaged accounts for somebody in this situation to be considering?
So this is for pre-retirement years, right? So think about what options you have available to you. If your employer does have an employer-sponsored plan like a 401k, you'll want to take advantage of those contributions. And those contributions into that 401k are larger percentages than what you can do on a Roth IRA or an IRA. Other accounts that you could fund during this window would be a health savings account, an HSA, a Roth IRA, and when you're talking about the 401k, the limits that are in this example here are a 60-year-old couple. They have the ability to do $24,500 a year per person contribution to the Roth 401k, plus an $8,000 catch up, plus an additional $3,250 super catch up. So that's a lot of money they can do into those tax advantage accounts.
Yep. And so that total for the super catch up is $35,750. I'll say that's a new thing. So that became available as a planning or funding limit very recently. There's a bit of a nuance to the way that the rule works too. It's only for people turning age 60 to 63. So in this situation for this couple that we're talking through, they'll be able to do that for a couple of years. And then even though they're still working, they'll actually lose that ability and they'll go back to the normal catch-up limit, $32,500 this year. The Roth IRA, or likely a backdoor Roth contribution if they're eligible in this situation, that limit is $8,600. And then the HSA limit, if they're on a family plan, would be $9,750. And one item to note there is all of those limits get indexed for inflation. So typically, we're filming this in 2026. Typically, every year, those limits are going to go up a little bit. And so that's one thing to monitor and be aware of on a year-by-year basis. With that, let me go ahead and turn it back over to you, Chad, for item number 2, which is consider Roth. So let me ask you the question, Chad. If somebody is in the late part of their career and making good money, why would somebody want to consider funding Roth?
Michael, thank you. The consideration is based on ultimately they've done an incredible job working, earning, saving, and planning for retirement. With their $2 million they have in their tax deferred retirement accounts, that $2 million will have a required minimum distribution that is going to be income that is going to be forced upon them at age 75. So any dollar that they could put into a tax advantage account like a Roth IRA, or if they even have it available, a mega backdoor Roth IRA through their employer plan, is funds that is removing from that required distribution down the road.
So I'll say, if you haven't ever heard of the term mega backdoor Roth 401k before, we will put a link up here in the top corner, but that's actually a video that we recently filmed breaking down how it works, what it is. Love for you to check it out if that's something that you're interested in. The cool thing about it is if your plan allows it, you can actually fund 80,000 plus dollars into a 401k, all Roth, all in a single year. So for people who are making good money and they have a lot of money to save, it can be a fantastic avenue for them to be able to do that. And all of the growth becomes tax-free as it receives the Roth treatment. If you don't have the mega backdoor Roth funding option, everybody can do 32,500, which is the normal plus catch-up limit into a Roth 401k. And we're happy to give you feedback if you're not sure. There's a document called the summary plan description that every 401k has, which is what you would want to look at to see if your plan allows for the mega backdoor Roth or not. All right. Item number 3 for you, Chad, taking tax losses. Why don't you break that down for us?
Thank you, Michael. Great clarification on the last point as well. So, tax loss harvesting can be done. Uh, this couple has $1 million in an investment brokerage account that will have both gains and losses in it over any individual moment in time or over their lifetime. So, taking a tax loss harvest on that is if one of their investments is down, let's say, for example, 20% on a year to date number, you can sell that investment at a loss and repurpose those funds into some other type of investment. And oftentimes $1 million brokerage account will have, you know, 20, 30, 40, 50, maybe 100 different investments. And all of them will be up or down at different phases of the market, which will provide those opportunities to process some tax loss harvests.
Yeah, and from a tax planning perspective, what's valuable is if you're making good money, you're likely in one of the higher capital gains brackets. So that could be 18.8% if you're in one of the top tax brackets. It could be 23.8%. But a lot of times, what we see is when you stop working, we'll talk about this a little bit later in the video, but when you stop working, you gain more control over how your income is received and is taxed. And a lot of times that means you drop tax brackets pretty significantly. And so if we can take losses at 18.8 or 23.8 instead of 15 or 0, it's going to produce a net positive impact on your lifetime tax bill. So the next couple items that we're going to hit on are going to be a couple tax planning opportunities that I'll say if you have a financial advisor who's not looking at your tax return, likely they're not spotting these opportunities. And it's one thing that as we've integrated getting every client's tax return and reviewing it as part of our planning process, it's allowed us to spot a lot of opportunities and potentially add a lot of value. And so the first one is going to be pre-funding charity. And so what I mean by that is we have a lot of clients that are fairly charitable. And a lot of times what we tend to find is people who don't have a tax planning game plan for their charitable giving is they're just very generously giving, call it $10,000 a year in cash to an organization or a number of organizations. And so this idea of pre-funding charity is if we're currently working and we're making good money and we're in a much higher tax bracket than we're going to be when we stop working down the road, that tax deduction is much more valuable now than it will be after that point in time. Additionally, our government passed a tax bill late last year in 2025. One of the things that tax bill did is it raised the standard deduction a little bit. And so the standard deduction is quite high here in 2026. It's $32,200. For those over 65, it's actually a little bit higher than that. But for this couple, $32,200. And so that's essentially the bar that you have to eclipse before you get a value from any itemized charitable deductions, of which charitable giving is one. And so if we can have more charity in 1 year when we are itemizing, that's pure deduction as opposed to having to eclipse that $32,200 figure. And so to go back to the example before where somebody's giving $10,000 a year in cash, and we know they're currently age 60, and we'll talk about this later in the video, the ability to do qualified charitable distributions, which you can do starting at age 70 and a half. So if we wanted to pre-fund the next 10 years worth of giving by bringing the back 5 years forward to the first 5 years when you're working, instead of $10,000 a year, we could fund what's called a donor advised fund, or we like to call them foundation accounts, with $20,000 a year. And instead of giving cash, we can pick the most appreciated stock. So like Chad talked about before, for the names that are down, we can do tax loss harvesting to realize some losses. For the names that are up, the way that we can rebalance out of those names and reduce exposure is that's what we can gift to the foundation account. The foundation account is a charitable organization in and of itself, so it can turn around and sell those investments and pay no tax, and charities can do the same thing. And then that money can continue to grow tax free until you ultimately gift it out to the charity of your choice. So you continue the same $10,000 a year giving that you were already doing, but it's coming out of the foundation account instead of out of your checking account. The other thing I'll add is, with that, you can also control when you make those bunching gifts. And so if you're in a job where you have variable income, and let's say there's a really good year where all of a sudden you're making $1 million plus, you're going to be in the top tax bracket, a deduction is more valuable. We could bring forward more of those years of giving all into that year because it's going to be a more valuable deduction. So let's say we were 62 and we had 8 more years to go. We could just go ahead and put $80,000 of your most appreciated stock into the donor advised fund. You'll get a 37% of $80,000 tax break. And then that money will be invested and be able to grow until you ultimately gift it out to the charities of your choice. The other tax planning move that we wanted to bring up that I'll say ties into that, because it's also an itemized deduction, and it's also something that was impacted by the tax bill that was passed late last year, is the state and local tax, or sometimes known as SALT tax deduction. So it used to be that that was capped at $10,000. The tax bill from last year increased that up to $40,000, and then it phases back down to $10,000 if your income is above a certain threshold. So the phase out range is adjusted gross income, or AGI, from 500,000 to 600,000. When you're above 600,000, you're fully phased back down to the $10,000 deduction limit. So part of this depends on where your income is, whether this strategy would make sense. But here in Texas, a lot of times most people's SALT taxes are their property taxes. And let's say you have a $20,000 property tax bill. What you could do is, instead of paying that in January of every year, you could bunch those together and you could pay January and December. And so both payments are in the same year, and you get a $40,000 state and local tax deduction that year. And then the next year you forego any deduction, and you can essentially alternate years. And you could pair that with the funding of the foundation account that we talked about before. So those are the 5 items that we wanted to hit on pre-retirement strategies to consider. Now we're going to turn it over to post-retirement strategies to consider, and I'll kind of I'll set the stage of what we want to consider here by talking through what I like to call the retirement tax planning window. So a lot of times what happens is people are making good money, they're working, and then they retire. They get the ability to control their tax bill. And in this situation, they have a large taxable investment account, which would be where we would want to take money from to fund lifestyle, where there's a good chance that their income could drop to zero or very close to it. And I call that the retirement tax planning window, is age 65 when income turns off to what we call forced income events. So for this couple, Social Security at, between 65 and 70, and then required distributions, which would turn on at age 75. So the opportunity that people miss is they don't take advantage of the fact that they're in low tax brackets by doing proactive tax planning strategies. And that's what we're going to talk through a little bit here in this part of the video. So I'm going to turn it over to Chad at this point in time. The first concept that we wanted to talk through is required distributions, how they work, and for this particular couple, what the projection of those required distributions would show them being forced to take once they turn 75.
Thank you, Michael. So the required minimum distributions are something that we will review with clients during a planning session or a strategy meeting. And the point of that required minimum distribution chart is to really help them visualize what type of income is going to be generated and or forced to be withdrawn from this IRA starting at age 75. So in this example with the couple that has a $2 million retirement account, um, and utilizing a 6% average annual return, that their first year at age 75, they have to take out $194,842 out of the account.
Yeah, and one thing I'll add just for context on how this works. So every year, the IRS looks at the balance of your account at the end of last year. So December 31st of the prior year, they take that balance and they apply a divisor that's based on your age. So essentially, it's a percentage of the account that you have to take out every year. And as you get older, that percentage goes up. And what we tend to see is even though you have to take some money out every year, if you're forced to take out more than you need to, you're probably having growth in the account that exceeds the required distribution over time. Plus, you have to take out a bigger and bigger percentage over time as well. And so we'll put this up on the screen so that you can see the required distribution planner that we're talking through here. But like Chad mentioned, at age 75, it's approximately 195,000 that they would have to take out. But if we fast forward 10 years, at age 85, it's all the way up to 325,000 approximately that they're forced to take out. The other consideration that I always like to bring up with this is if you're a married couple, like this example that we're talking through, one spouse is typically going to outlive the other spouse. And when that happens, generally the required distributions don't go down, but the surviving spouse finds them subject to single tax rates as opposed to married filing jointly tax rates, which are often much worse. And so just for context, a $325,000 income on the married side would put you in the 24% bracket. On the single side, it would put you well into the 35% bracket. So an 11% jump. Plus, the brackets are much more consolidated, meaning you're paying a much higher rate on much more of that income as well. And then the last thing to be aware of is when the surviving spouse passes, generally the money goes to the next generation, and they're going to be subject to a 10-year rule that they have to take that money out. And a lot of times that happens when they're in the prime of their career, they're making good money, and now they have additional money that they have to take out every year on top of their income that can push them into much higher tax brackets than you may have been in or may have had the opportunity to do what's called a Roth conversion in at very low brackets during this retirement tax planning window. Chad, let me pass it over to you to talk through the next concept, which is Social Security and what we like to bring up or think about there.
Yeah, so each client has a Social Security planner that we will review and discuss together. Again, one of the items that we do here at this firm that I believe is a tremendous value add that we were not able to do at previous firms is we are able to review clients' tax returns. And we do ask for their Social Security report so that we can run a planner and make some determinations on when is the best time to take Social Security. And Social Security, as it works, is you can start taking it at age 62 up until age 70. And essentially, each year you're going to get an 8% cost of living adjustment, or excuse me, an 8% guaranteed increase from the government with about a 2.5% cost of living adjustment. So we'll add to this video, this planner that shows this analysis. And if this client were to take it starting at age 65, their combined total Social Security benefit would be like $2.2 million over the lifetime. If they wait until age 70 for both of them, their combined benefit is $2.6 million. So materially greater. Obviously, decisions based on health and longevity and other items come to come into the conversation at that time frame. But we do these planners with every household, and we believe there's value in doing it.
Yeah, and from a tax planning perspective, I'll say the back page of this planner we'll put up on the screen now shows if this couple waited until age 70, which I'd say unless there was a health issue that caused us to believe that they weren't going to last until a certain age, which the break even age that as long as you live until age 75 is the break even age in this scenario, you will have gotten more out of the system by waiting than if you claimed at an earlier age. And so we're assuming they're going to live past age 75. And if that assumption holds true and we claim at age 70, what we're showing on the screen now shows year by year what is that benefit actually going to look like as far as monies received. Um, and so if we look at age 85, so we talked about the required distribution at age 85 was $325,000 approximately. That's in addition to a Social Security benefit of about $209,000. The way that Social Security works is it's partially taxable between 50 and 85%. In this case, it's safe to assume 85% of that $209,000 would be taxed as income. And so we're talking about a total income that's approaching $500,000, even though this couple is not working and not asking for any of it potentially. This is money that the government has said you're receiving this and you have to take this from your retirement account. And so to kind of allude back to some of the concepts that we talked about earlier in the video, like funding Roth, why would you do that? This is why. And then when we talk about the tax planning window, where potentially income can drop to the 0% bracket or close to it, um, what do we want to do about it during that window? We want to do Roth conversions. We want to take some of our IRA money and say, I'm going to intentionally pay taxes on this money and I'm going to flip it over to Roth because I can pay 0%, 10%, 12%, even in this case, 22 and 24% makes sense to do because we know we're going to be subject to much higher tax rates down the road. And so that's one thing that I'll say in this situation, that would be the planning item that I would look to complete every single year from age 65 to 70 when Social Security turns on is let's try to convert as much money as we possibly can. That's going to reduce our future required distributions and it's going to lock in much lower tax rates than we're likely going to be subject to. Even at age 70, Social Security turns on, we still probably want to do Roth conversions until those required distributions start. But our window is going to be smaller. If we have $209,000, or it was a lower number at age 70, but we have significant Social Security income coming in, that's probably going to eat up some of the lower brackets, but it's still going to, in the current tax situation, still going to potentially give us the ability to realize income at 22%, at 24%, which is much better than if we're paying 35% or some higher amount down the road. I will bring up that depending on the situation, I'd say it doesn't make sense in this situation, but the other planning opportunity I like to take advantage of during this retirement tax planning window is what's called the 0% long-term capital gains bracket. And so for a 65-year-old couple, the top of the 0% long-term capital gains bracket is standard deduction. So call it 35,000 or so, plus the new senior deduction, which is $6,000 per person or $12,000 for a couple that's on top of that, plus $98,900. So a pretty high bar for the 0% long-term capital gains bracket. So if they had less pre-tax retirement money, that would be a strategy that I'd look to consider utilizing is as we fund their lifestyle by sending money, we can intentionally realize long-term capital gains that we pay no taxes on. So for the right person, it makes sense. In this situation, I'd say the Roth conversions makes more sense, but there could potentially be a pairing of the two in certain situations. I did want to hit on what's called IRMAA, IRMAA. We like to call her Crazy Aunt Irma. What that is that's your Medicare surcharge. And so when you turn 65 and you get on Medicare, one mistake that I'll say we see retirees make is they stop working, they get on Medicare, and they're subject to much higher Medicare surcharges because the government is looking 2 years back to determine your Medicare surcharges, and they were working when that happened. You can actually appeal your Medicare surcharge if you've retired and have that income removed. And so that's something that you can work with your CPA on, but it's a mistake that we see people make is they don't do that and then they pay much more in Medicare surcharges because of it. The last thing that I wanted to hit on as far as post-retirement planning is concerned that we talked about earlier in the video is the ability to do qualified charitable distribution. So at age 70 and a half, that's when the ability to do this turns on. And what that is at that point in time, you can actually give money directly out of your IRA to charities. And so in this situation where they have a required distribution problem, that's a great way to get money out of their retirement account and do so tax-free. And then once they reach age 75, that money that they give to charity actually counts towards their required distribution as well. And so if somebody has a $150,000 required distribution, for example, and they say, I'm going to give $25,000 to charity this year, the 25 goes out of the IRA to charity. They're only forced to take out 125,000 that's going to be taxed as income. Talking about IRMAA surcharges, the Medicare surcharges, the last thing I'll add is your required distributions and your Social Security. The government is looking at that when determining your Medicare surcharges later in life. And that's another reason to do these proactive Roth conversions. And a mistake we see people make is they don't want to do it because they don't want to have to pay higher Medicare surcharges now. And they neglect the fact that they're going to pay significantly higher Medicare surcharges for the rest of their life as a trade-off. Chad, I know we went over a lot today. Anything that you want to add or anything you want to say to wrap us up?
I'm still mesmerized that, this example for this household is, needing to take out potentially about $530,000 at age 85, even if, they don't need the funds. So, to me, this was a great example in terms of different strategies that we take with clients each and every year as they are, pre-retirement and into that tax retirement planning window. So for wrap, I would say, let's keep tax planning as a priority and help our clients where we can.
Thank you so much for joining us on today's episode of Cuppable. If you found this conversation helpful, please feel free to click the subscribe button down below. We do also have a link down in the show notes. If you would like to talk through your situation and how some of these strategies may apply to your particular situation, there is a link where you can schedule a time with a member of our team to talk through that. That all said, I will wrap us up today by reminding you to rebalance until rich.
Cheers.
Cheers.